Welcome back. Hi, I'm Hammer, and I would like to welcome back to the show Heather Foster from Foster Financial. Thank you so much for being here. We're going to talk about markets today, right?
Yeah, I think everyone's talking about the markets right now, so I think it's a good time just to chit-chat about what's going on in the marketplace. A lot of people are starting to feel antsy. We've kind of gotten to that point where, beginning of the year, hit all-time market high on January 3rd. We've been trending down. We had a little bump back in March and trending back down again. And it's kind of getting to that reminiscent point where people, again, are saying, hey, are we going ahead and heading into a recession right now? Because they haven't felt this way, or we've seen, 6 months of negative volatile times for a really long time. I mean, we've seen months like in 2020 where we had the market drop 33% over a few-week period during COVID. And we've had plenty of corrections since 2008, 2009, where we've seen 3-month declines, 4-month declines. But going into 6 months, it's starting to get people a little bit nervous. So I wanted just to kind of talk about that, because there's moves that you can make to help yourself, and there's moves that you can make to harm yourself.
And I'm going to write them down.
Yeah, during market declines. So the first thing I want to say is that, up until this point, we've been in an undervalued market. So if you were a growth player, you were heavy into growth playing stocks, you've made a lot of money since 2008, 2009. If in 2008 and 2009 you got scared and you went to something safer, you've been lagging big time. But now the ball has kind of changed court a little bit. So up until now, we've been undervalued. The reason we've been undervalued, a lot of it has to do with corporate profits and interest rates. Because interest rates are rising so fast right now, we just stepped into what we call fair market territory. So think of it this way. If you got a marketplace, it's kind of like this. If you're undervalued, you're buying down here and your upside is pretty great, right? But if you step into fair market territory, your upside is a lot more limited. You've got more downside risk as well. So fair market territory, you're not really overpaying yet to buy into the stock market, but you're not buying at a discount. Now, the flip side of this, up until now, we have been at all-time low interest rates. So to get out of the stock market and go into something that was safer or more, less risk, you were basically giving up everything, because you were saying, hey, I got to trade the market side for something that's earning 0.01, right? People at the banks, you guys all know what I'm talking about. Interest rates have been held down artificially for so long, you really only could make money in the market side. But now that's changed a little bit. Now we're seeing CDs and bonds and fixed annuities finally seeing in the 3, 4, 5, 6, 7% interest rate range again.
That sounds crazy after where we've been.
After where we've been. So here's the question, and going into the next market cycle. Up until this point, and I've not been able to say anything like this since 2007, 2008, because we've not seen interest rates come up like they have. On the one side, the market is now fair market territory. If they continue to raise interest rates, we will go into overpriced territory, meaning our upside is very limited. Now that we can finally get 6 and 7% returns potentially on bonds and individual, more conservative investments, there may be a place for certain investors to think about repositioning. Normally, I'm not one to say move it to something safer. I'm a buy and hold. I love the stock market. And there's always things that go up when everything else goes down. I'll actually give you an example. I sold off of a bunch of technology stock in my portfolios that I manage, and I bought consumer staples. I bought commodities, oil, gas, and energy. This was in February of this year. The things that I sold went down another 22% since I sold them. The things that I bought have went up significantly. So it's a big move in what we call sector modeling. So I'm not saying that you should reposition everything into fixed income assets. I'm just saying that make sure you have a long-term plan, because we are heading into a different market cycle. We are not going to see the markets look the same way they've looked for the last 10 years. It is something that you guys need to get your pulse on. You don't want to be chasing the puck behind you. You want to make sure you're going towards where the puck is going.
Thank you so very much. And if you have financial questions, we'll call the number on our screen for a complimentary consultation today. Thank you very much for being here.